Welcome. Nice and intimate group. Thank you. Thank you everyone for being here. We'll keep the program nice and concise. I'll tell you the order of events for this evening. I will give a quick introduction, and then I'll turn it over to Aidan and my father to banter and debate a la Ward and Charlie about a little bit about equities, how they work, how we select them, and how we don't select them, most importantly. And so with that, everyone should have a couple of pieces in front of them. One's in this plastic sheath. It's everything's paginated. It's a 7-page document. And then, of course, this Pacer ETF. Cows is one of the positions out by Pacer that we're including in every single client portfolio at the moment. And you'll learn why. You'll learn what methodologies we use and why we use it. Very quickly, I want to give everyone a little bit of something to chew on about estate planning, tax minimization, tax deferral. The first thing I want to think about is the estate tax exemption that's changing. So anyone who has an estate that will be in excess of $10 million upon death, assuming you survive the next 18 months, will have a taxable estate. Included in that number is pensions, life insurance, etc. If money doubles every 10 years, which it should, anyone with a taxable estate right now worth more than, say, $5 million has a problem to think about. So I would suggest that you reach out to your local estate planning attorney and think about planning. So if today you have a taxable estate in excess of 5, and you intend on living more than 10 years, you've got a problem. That's sort of a rule of thumb to think about. Another fun hack or trick that I want to recommend to you, or recommend to clients, I actually funded a 529 for myself and my wife this year. I have no intention of going back to school, none at all. Proud of my academic achievements, and yet I put $10,000 into a 529. Why? Because you can convert it to a Roth. And so in effect, I funded a Roth through my 529. So a quick little hack, go home, open a 529, put $10,000 into it. When it grows to 35, convert it to a Roth, and you've got a Roth that you can then use in retirement or leave to the kids. Other things we're thinking about is upstream gifting. For clients who have elderly parents or aunts and uncles who do not themselves have taxable estates, you can move wealth into their name technically and get a step up in basis upon their death. So for many real estate clients who have highly depreciated real estate assets, which sometimes have negative basis, you can actually have negative basis in the context of real estate. You can move that technically into the taxable estate of someone who's older, an aunt, an uncle, a parent, and get a step up in basis. In theory, that person has to know. In theory, that person has to know that that's includable in their taxable estate. But obviously, family dynamics come into play, and we're doing that all the time. Highly appreciated positions. One of the beautiful things about an ETF is that you can shed positions when you no longer want to hold them. So you've had a phenomenal run with pick your favorite company, pick your favorite brand, but there's not really a great way to get out of it if you hold the stock directly. You can through the context of a donor advised fund. You can through the context of blocking and borrowing against that strategy. So we have a toolbox of great ways to deal with highly appreciated single stock exposure. Either through charitable giving, which doesn't have to be that philanthropic. That's the secret with some of these strategies. There has to be some philanthropic intent, but you don't have to be the greatest philanthropist in the world to use some of these strategies. And then, of course, life insurance. Easily excluded from your taxable estate. Easily. Establish life insurance trust, move life insurance into it, and that is excluded from the 10 I was describing. One other quick comment is that the Secure Act will affect virtually everyone in the room relative to pension planning, income tax, RMDs, etc. There's a handout in the back about the Secure Act 2.0. I don't want to spend too much time going through the details, but a couple of highlights. There's this brochure, just a 2-page pamphlet we had on the back. But basically, RMDs are now a year later, contributions and catch-ups are changed, how it affects younger participants is all varied. Touch base with your pension administrator or tax advisor, but just know that we will all be affected by the Secure Act 2.0 relative to how it affects our own retirement plans. So with that, I want to introduce Aidan. One of the nice things about the ETF structure is, where's Aidan?
Yeah.
I think I have to pause for a minute while Aidan comes in.
Yeah, sorry.
Pacer is an ETF issuer. You can see that they're here. They developed a strategy called COWS, C-O-W-Z. It trades under the ticker COWZ. And the nice thing about ETF issuers is this ability to buy a definition rather than a series of companies. And you can confidently leave that definition to your kids and grandkids and know that through the passage of time, the components of that block will change in a dynamic, tax-free manner. But it will always comport with the definition you're seeking. And Pacer developed this fantastic tool which focuses sort of agnostically on positions that have free cash flow or growing free cash flow to their investors. And it's a great way to determine what you want to hold. You know, when I was studying finance, we used to study Peter Lynch. Buy what you know. If you love your car, buy the brand. If you love the pharmacy you shop at, buy the stock. It doesn't work. It doesn't work. And it certainly ends at some point, because trees don't grow to the sky, and there has to be a way to shed what you bought. And by buying a definition, you can ensure that you always own the best in breed in a particular class or asset type in a dynamic way that evolves over time, but you always own that group of winners. And I was hoping Aidan would join us from Pacer, but he's not here.
He is here.
You see how it's like getting food?
I think that's his.
I'm going to go get Aidan, and Dad, you can maybe debrief on some of our. My father and I and my son Lenny, who's 12, had the phenomenal experience this past weekend of hearing from Warren Buffett and Charlie Munger for an incredible 8-hour.
6 hours.
6 hour.
The one's 99 and the other one's 92. Just so you know what it's like, 30,000 people crowd into Omaha for this weekend, some say 40. And you hear a 99-year-old who's completely with it, with a 93 who's completely with it. And by the way, for those of you who are interested in longevity, you can't learn a thing from them. The two of them, while they're talking, are drinking cherry Coke and eating See's candy peanut brittle. No joke. And in fact, they don't care about how it sounds because they're eating and crunching it, and the microphone's in front, and you can hear the crunching peanut brittle between the answers. And yet the wisdom that comes out is unbelievable. And I will just tell you this. I don't do business on the Sabbath. I happen to be Jewish and traditional. And a friend of mine said to me, I'm surprised you go, because on the Sabbath you traditionally don't do business. And I said, we don't go there to do business. We don't go there to get stock tips. We go there to get wisdom, and you can get wisdom on the Sabbath. These people do not talk about stock tips. And by the way, if you want the stock tips, they know, you know exactly what they're doing. You go there because you learn how to think, how to approach life, how you approach relationships, how you approach wealth accumulation, what you do with wealth. I'll just give you just one quote, just to give you a sense of it. Somebody asked Buffett, why do you leave such a little proportion of your money to your children and grandchildren and not more, and why do you give so much to charity when you die? Why? And he stated what his will is. And he said, my philosophy on money is, you should leave your kids enough money so that they can do anything, but not so much money that they can do nothing. That's a typical Buffett, typical Buffett. You know, I mean, we quote him, we live by him. And as I tell people, you know, I follow dozens of people. That's what I actually do. I don't read novels, and I don't watch movies, and I don't binge watch. I read financial stuff, and I follow probably 4 dozen really great people. There's nobody else I can tell you has influenced who I am as a person as much as Warren Buffett of the financial people that I read. I don't look at the feeds on Bloomberg and all the other feeds we get to change who I am or become more elevated as a human being. I learned that from Buffett and Munger. And if you want an education, watch a YouTube of Charlie Munger. He's an extremely wise man. And just a couple of things before we...
Aidan's coming in, sorry.
Yeah.
In the room, we've got Eric Stevens of our wealth management team.
Yeah.
We've got Lois Eam of our affiliated tax and accounting firm, and my wife Natalie, and then my father and I. And we're 20 professionals on the wealth management side, about 65 on the tax and accounting side, and together we manage just over $1 billion of client wealth in 2 offices.
Correct. And just if I can just parental oversight here, Jonathan mentioned a couple of things that if I can, I would just like to expand on just a smidgen because I think they're important. He spoke about the estate plan. I wanted to just specify that everybody should know that he referred to the $5 million that will revert to at the end of 2025, which is a sunset provision built into the Act. But between now and then, it's $13 million per person. So you can leave up to $26 million now. But at the end of December 25, unless things change, it's set to sunset to $5 million per person. I wanted you to understand the difference. It's a massive decrease from 26 for a married couple to 10. Just in terms of upstream gifting, he alluded to it, but I want to make sure that you understand how that actually works because it might be interesting to you. The way you actually include it in somebody else's estate is you give that person a general power of appointment. It's a technical term that gives them the right to do whatever they want with your money. Whatever they want, you give them total power to be in control. Now, obviously, you have to trust the person, but in that case, not an issue. And if there are no, as Jonathan said, no family issues, you can do that. And we've had remarkable success. We have a client who has some real estate, and as I think you picked up from Jonathan's comments, a large real estate, massive appreciation, and a negative capital. That means the moment you sell it, not only do you pay tax on the gain, but the whole negative capital also gets taxed. By gifting it to an elderly parent-in-law who didn't have much, they were able to get this to a step-up in basis where they could sell it the day after death and pay absolutely no tax, no capital gains tax, no recap, because it's all been sanitized through the bequeathing process because the person who died had under the exemption amount. We are going to talk about 3 new programs which we're introducing. The first one, which thank you, Aidan, for being here with Pace, and Jonathan has spoken to you about that. We'll get into that in much greater detail with Aidan now. The second one is Cliff Water, which is a high income fund ideal for people who are seeking great income and don't have a tax consideration because it is taxable. It's also ideal for pension and retirement plans, where of course you're in a tax-free zone anyway. That is the second of 3 new introductions. And the third one is JPM REIT. JP Morgan, there were 2 of them were outside here, they had to run, but we've become very big investors, and I want you just to know, because this is how we do things. Jonathan and I always put our own money first. We never advocate that our clients invest in anything that we don't. So I just want you to know, Jonathan and Natalie, of course, Jonathan's family, and Glynis and I, my wife and I, have significant money in JPM REIT before we would even talk to you about it. And I will get to those both later on as to why we've included these 3. But for right now, we're just going to deal with the first one. We're happy to have Aidan O'Hare. Turns out Aidan has Irish heritage. Jonathan has Irish heritage too, as do I, because my wife and her whole family comes from Ireland. And so we have Irish heritage deep. In fact, if you go to the Jewish Museum in Dublin, you will see that my wife's grandfather was the first printer of Judaica in Dublin, and there's a printing press after him. His original printing press is still there, with a couple of early specimens of the books that he printed in Dublin. So we have that commonality, and of course the other commonality is we both love cows. And so with that, because of what it is and what it does. So with that, Aidan, it's a pleasure to introduce you. I'm going to leave you up here alone. Aidan is going to take us through macro, micro, why Pacer chose to develop cows, and therefore the things he's going to tell you are precisely the reasons why we like it. And the reasons we like it are because it meets our criteria, and you'll find out what they are. With that, Aidan, thank you for trekking up here to be with us tonight. Very honored to have you. And the floor's yours. I'll come up and question you and banter with you when you're done. So thank you.
Perfect. All right. So first of all, thank you for having me here. I really appreciate it. Thanks for thinking of Pacer for this event. So by means of just a quick introduction, my name is Aidan O'Hara. I run institutional sales at Pacer ETFs. I work on the portfolio management team, and so on the portfolio management team, I'm one of 3 people that's responsible for investment research, just for our clients and our clients' clients, such as you all. And I've been with the firm for about 5 years, and yeah, so as far as kind of Pacer, who we are, what we do, it's probably not a firm that a ton of you have heard of. We generally like to market to financial advisors, so we very much believe in the power of the financial advisor, what they offer to their end clients, and partnering with financial advisors to try to deliver the best outcome to clients. And what we do is a little bit different from most ETF shops that are out there. So when you hear the word ETF, if you know what the word ETF is, or if you're familiar with that word, generally when people think of ETFs, they think of just kind of broad exposure to an index such as the S&P 500. So you buy a product and that's just going to give you exposure. You're going to own the S&P 500, and that you'll get whatever the performance is of the S&P 500 over time. Where we're different is that we take an index, basically, and we are a rules-based, strategy-driven shop. So we will take an index and we will apply a set of rules to it or a strategy to it and try to offer a differentiated product that looks different from just owning the market, right? Because so many products give you exposure to just the market. We want to offer that's something that's entirely different. So I'll get into that in a second. That's enough of a plug for Pacer. There's handouts that everyone should have, and within the kind of booklet that I handed out, there should be an additional piece of paper. So everyone should have this with the cows on the front, and then this thing that says identifying the value, opportunity, and intangible assets as well. So I'll get into the cows in a second, but let's just take a step back and talk about how we got to where we're at, because it's been a heck of a couple of years in markets. It's been really, I haven't been in the business for as long as some of these gentlemen have, but it's been a very unique couple of years to get to the point that we're at. And if you think about where we're at now, I think that the story starts all the way back probably at the financial crisis. You could argue potentially before that. And what happened during the financial crisis, one of the really, really big things that drove the market over the past 10 to 12 years up until the beginning of 2022 was the fact that the Federal Reserve stepped in after the financial crisis, or during the financial crisis. So during the financial crisis, the Federal Reserve stepped in. They lowered interest rates to basically zero over that period of time, at least short-term rates, and they injected a ton of money into the economy. So it was called quantitative easing, and it was a historic thing that they did. They just injected as much liquidity basically as they could into the economy to make sure that we didn't go down a road that was headed toward catastrophe, even though it was not an enjoyable experience. It could have been worse if they didn't backstop the economy in the way that they did. And that changed the investing game to a very large extent. And it changed the investing game in a couple of ways that I think are really important to what we'll talk about with regards to what Pacer's solution is, but just in general, right? Over the period of time from 2009, March 2009, when the market bottomed, really until, I guess, COVID, we'll touch on that, but really that kind of era continued until the end of 2021. And it changed the investing game in that lowering interest rates to the level that they did, basically having 0% interest rates, means it didn't cost anything for companies to borrow money through that period of time. So we had relatively no inflation over that period of time, right? We haven't talked about inflation. If you X out the past 18 months or so, we hadn't talked about inflation since the 1980s, right? The period of time from 1967 to 1982, the great inflation period. It wasn't much of a concern to people. And so bringing interest rates to that ultra low level and having inflation be super, super low basically meant that when you were looking at investing in companies, there's two kind of really important aspects to that. Number one, if inflation is super, super low, that means that $1 today is worth about as much as $1 in 10 years' time, right? If there's no inflation, that means that you're going to be able to buy basically the same amount in 10 years as you could today with $1. Now, if inflation's high, we've all experienced this over the past year and a half, $1 in 10 years is worth a lot less than $1 today, right? The amount that you can buy with your $1 in 10 years is going to be significantly lower if inflation is somewhere between 5 to 8% versus, below 2%. So that's number one. $1 in 10 years is basically worth the same amount as $1 today. Number two, it meant that companies could borrow incredible amounts of money and take on enormous amounts of debt, and there was basically no consequences, right? So if interest rates are zero for 10 to 12 years, and you are a company that is not really making money, which most people would say is not a real company to an extent, at some point you have to turn a profit, but there was an extended period of time over that 10-year period from 2009 or 12-year period from 2009 until COVID. If you're just taking on more and more debt and you're not making any money, but you can afford to stay in business because it costs nothing for you to continue borrowing money, right? Then that's one way to stay in business. So the way that this affected the overall market, to kind of tie it in, how does this affect your actual investments, is that when you look at a stock, and this happens all the time, and I'm a younger guy, and so a lot of my friends got caught up in like this meme stock craze, and were telling me that I was an idiot for not investing in certain bankrupt companies over the past couple of years. I had the last laugh, but whatever. But when you look at a stock, sometimes it's easy to look at a stock and think of it as a just line on a page, right? Sometimes they seem so foreign when you invest in a stock that you're not really in tune with what you are actually buying when you buy a stock. But when you buy a stock, you're buying a portion of a company, right? And when you buy a portion of the company, what that means is you get a portion of the profits. So a stock, at its core, is a cash-producing asset. It has to make cash over time. But 0% interest rates and essentially no inflation, what that did to investors is that they basically said, well, I'm willing to invest in these companies that have way too much debt on their balance sheet. They're just taking on exorbitant amounts of debt. And because $1 in 10 years will basically be the same amount as $1 today, they don't have to make money today. They're taking on debt right now, but they have this technology or whatever it might be where in the future, this company is going to make a ton of money, right? They're taking on debt now, they don't make money now, but take my word for it, 5-10 years from now, this company is going to do exceptionally well. So they were willing to delay those cash flows that they wanted to receive, right? So what that does for the overall market is basically it bids up it's called valuation levels of the market or the multiples of the market. And a simple way to think about that is that people are just willing to pay higher prices for stocks, right? If inflation is relatively low and interest rates are relatively low, people are willing to pay higher and higher and higher prices. And we didn't get to levels that were seen during the dot-com bubble, but we got pretty close to that after the whole meme stock craze. I'm sure, if you turned on any financial news outlet, you saw something about, AMC on there or GameStop on there, which pretty much everyone knows were going out of business at that point. And people just bid up these prices super high, right? And then something changed, and that something that changed was that we turned the corner from 2021 into 2022, and all of a sudden, people asked what I think is the most important question when you're going to invest in a company, which is, does this company actually make money, right? that's probably a good starting point when you are going to invest in a company is, does this company make money, especially in your public equity portion of your portfolio? Does this company actually make any money? So a lot of the pain that happened last year, it's been a good year this year, but a lot of the pain that happened last year came from that big sea change of people being willing to invest in companies that didn't make money, that had too much debt on their balance sheets, into, well, now my company needs to make money. And people, because inflation was super high, and I kind of mentioned this relationship, when inflation is high, people are willing to pay lower prices for stocks, and when inflation is low, people are willing to pay higher prices for stocks. So those two things kind of came together last year, and with high inflation, people weren't willing to just pay higher and higher and higher prices for stocks. Now you have to show me something. You have to show that you're making money, and you have to show that this is a reasonable investment, that I'm not paying a ridiculous price, right? If you were to go and buy a house, there's the amount of due diligence that you do when you're buying a house is an incredible amount, right? You're probably not going to be willing to pay 30% more than what that house is really worth just because somebody tells you that this house in this neighborhood in 5 years is going to be absolutely the best neighborhood and prices are going to skyrocket, right? You wouldn't be willing to gamble that amount of money on speculation. So those are kind of the main things that changed last year, and kind of how there was a big sea change in the way that people were thinking about investing. And I call it just back to the basics, right? Keep it simple, stupid, kiss, if you guys have heard of this saying, right? It's easy in investing because there's all this verbiage that you use for different terminology, and sometimes it seems like its own language. But at the end of the day, you want to get back to your roots, and keeping it simple with your investment strategy or with what you do is oftentimes the best way to make money over the long term and the most consistent way to make money over the long term, right? And that way is really kind of what Warren Buffett has done throughout his career. And it's what I mentioned, is this a good company? Is this a healthy company? Does this company make money? And am I paying a reasonable price for this company? And those are two very simple questions to ask, but unfortunately, in the environment that we were in, where there was kind of almost mania driven by the fact that it costs nothing to take on debt, people lost sight of that for a little while. And so there's been a big sea change recently, and again, we kind of just stick to our core of what we do. So what we do is outlined in the pamphlet that you all have that I handed out. So the series is called our Cash Cow series, which is why you see all the cows on the front. One of our owners is from rural Kentucky, so he was partial to throwing cows on the cover of this, and we had some fun with the naming conventions. Our large cap strategy is called cows, our small cap strategy is called calf. So we had a lot of fun with the naming convention there. But basically what we do is we look at something called free cash flow yield. So if you open your pamphlet, it's on the first page here. And there's a formula in the middle of the page where it says free cash flow yield. Free cash flow yield, is free cash flow over enterprise value. And enterprise value, as you can see kind of by the parentheses there, is made up of three components: market cap plus debt minus cash. So I will get back to that in just 1 second, but I want to touch on free cash flow and what free cash flow is and why it's important. I'll take a step back and talk about kind of what I talked about with inflation, right? The dollar being worth the same amount in 10 years versus what it is, today when inflation is low. And when inflation is high, the dollar in the future is worth less than what it is today. So all that is saying is that when inflation is high, doesn't matter if you are a company or if you are an individual, getting your cash now is important, because if you get your cash now and you have expenses when inflation is high, if you spend it now, it costs you less than getting that same amount of money in the future and spending it then. right? So cash becomes very important, and having access to cash becomes very important when inflation goes up. So free cash flow, and it's on here for you guys to see, free cash flow is really what is left for a company after they've paid their expenses, their interest, their taxes, and their long-term investments. So that's, what does that really mean, right? What that means, and why I think cash flow is important, is that it's hard to fake cash flow. Cash comes into the company and cash goes out of the company. Profits, on the other hand, can be manipulated. There's a number of different things through different accounting mechanisms where you can manipulate how much it seems like a company makes, but you can't fake cash. There's a certain amount of cash that's coming into the company, and there's a certain amount of cash that's going out. And so it gives you a measurement of quality, right? If a company is actually producing cash and they have cash flows coming into the company, it means that they are making money above all their expenses. They're actually a profitable company that's going to be able to hopefully give you money in the form of whether it's dividends or stock buybacks or going out and participating in mergers and acquisitions. They can use that cash to actually grow their business. So that's number one. That's why we like free cash flow. It puts you as the investor in the driver's seat, right? With profits, you don't know if this company is actually profitable necessarily, or if they have a really good accounting department and they were able to fudge this quarter's numbers a little bit and their profits aren't actually that high. A lot more difficult to do that with cash flow. And then, this is the other important component, is that we compare cash flows, free cash flow, to enterprise value. So market cap plus debt minus cash. So what are those three components and why are they important? Market cap basically is just the stock price of a company. It's the simplest way to think about it, right? Is what market cap is. So we're comparing the free cash flow to what the actual stock price is, and then we take into account debt and cash. So here's a way that I like to think about this, right? If you were to buy a company, right? If you were to go out, you were to buy a company, you would have to buy all the outstanding stock, you would have to take on the debt, and you get the benefit of whatever cash that company has, right? That's how you end up buying that company, right? So enterprise value is really just a proxy for the takeover price of a company because it has those three components. And what free cash flow yield gives you is basically the quickest that you can actually pay off that company. So if you have a high free cash flow yield, for example, if you have a free cash flow yield of 20%, that means that at that level, that company could literally buy back all their stock, pay off all their debt within 5 years' time, right? That's what a 20% free cash flow yield signals. So it's a good way to get at a very high current cash return investment, which is, again, very important in a high inflation environment. And the other thing that's very important is that in that equation, there's debt and cash taken into account. And for 12 years or so, nobody really cared about the amount of debt that a company had on their balance sheet. It didn't matter because interest rates were zero and it cost nothing to pay that debt. But if you've tried to buy a house in the past 18 months, you know that that's no longer the case. Debt actually costs something now. And so taking into account how indebted those companies are is very important in this current environment. And so basically, to kind of sum up what free cash flow yield is, what our strategy is it's a traditional Warren Buffett style approach. We want to get the most cash flows that we can for the least amount of dollars spent, right? That's all that we're doing with the strategy. It's a simple strategy. It's going back to the basics, but if you look at what's worked throughout all of history, buying profitable companies and making sure you're paying a decent price for those companies has essentially never failed, right? So it's the best way, it's been the best way to invest pretty much throughout history. And then on the back of this sheet, so that was all kind of on the front, on the back there's a scatter plot and then a bar chart. So the scatter plot is basically looking at free cash flow yield, which is again what we use, relative to other metrics that you could use to value a stock. So, when you value a stock, you're always kind of comparing something to the price, essentially. And the metric that you use is going to determine how well your investment does over time. So some of the most popular ways are price to book ratio, book being the book value of the company. You get into that in just a second. Then price to earnings. Earnings is just profit, which I've talked about, that can be manipulated. And then the third most popular way to do that is probably price to sales. In sales, which they're great, but they don't tell you much about a company other than their sales are growing. They don't tell you if that company is actually making any money. So for example, if you doubled your sales, but you were negative in profit, right? You doubled your sales, but you still lost just as much money. You're not really an attractive company because you're still negative in profit, right? So those are kind of the three most popular. And what this kind of scatter plot shows you is that free cash flow yield gives you the highest return, and the return is plotted along the vertical axis. So we're up in the Pacific Northwest quadrant there. So it gives you the highest return, and then more importantly, in my opinion, is the horizontal axis shows you percentage of negative 12-month periods. So how often do you lose money in 1 year? And it gives you the lowest amount of negative 12-month periods of all those different ways that you could value a stock. And I call percentage of negative 12-month periods, it's just client experience, basically. How often do you have to go into Jonathan's or Selwyn's office and say, why is my investment in this company or in this product negative, right? And generally speaking, the less often it's negative, the happier that you're going to be. So that's kind of your client experience. Again, if I talk too long, we should have those lights in the back somewhere, like they have when they're doing the awards acceptance speeches, where you can just flash it on me if I'm taking too long.
Thank you. You're doing great.
Yeah.
You're making it very clear to people.
Yeah.
Without getting too deep in the weeds, you could probably just talk about relative performance, the chart over here and the chart over there, just to show. But basically, if you look at the two charts, which is the bottom, the kind of orange one on the left over here, and the black one over here, what you'll see is how good the returns are. Can you just explain this one? That's probably easy enough, and then I'll come up here.
Yeah, so all the chart on the first page shows you is that only 15% of analysts use free cash flow yield, and that still is mind-boggling to me that more people don't use it. And the reason it's mind-boggling is on that chart on the next page. So the bar chart that you see that's below the scatter plot,
yes.
What that shows you is it's taking an index, which is the Russell 1000, which is basically just the S&P 500. If you went to the next 500 biggest companies in the US stock market, that's the Russell 1000. And it breaks it down into deciles, so 10% for each of those, based on their free cash flow yield. And it shows you their performance over time. And all this really tells you is that the highest decile of free cash flow yield gives you by far the best performance. So the higher free cash flow yield, that metric that we use, the better your performance is going to be over time. And there is essentially a linear relationship between a company's free cash flow yield and what your actual stock returns, the money in your account, is going to be over time. And the way that we are different from other strategies and other asset managers is that I mentioned at the beginning, most people in the ETF industry, most companies in the ETF industry, they look at this bar chart and they go, I don't really care. I'll just give you all 1,000 companies, wrap up this whole thing, and then you're going to get whatever the performance is that's smack dab in the middle, and I'm just going to give you, the market's performance basically over time. And our thought process is that if we could just offer you the best companies within the index, why would we not do that? So what we do is we take the top decile of free cash flow yield companies within the index, and then that's what we invest in. Go for it.
Are you basically advocating the cash method of accounting and forget all accrual accounting?
Yeah, I mean, to an extent, because...
No, I don't think that's, hold on, whoa, I don't think that's the case. I don't think that what the system does, first of all, I think, to answer the question, I think as crisply as possible, I think what the system says is, we don't want to deal with fictional accounting garbage.
accrual.
And, well, no. Accrual is not fictional
Well,
garbage.
accrual says that you've got a sale once you quote unquote book it, whether or not you've collected it.
Right. I don't think that PACER goes back to undo accrual accounting. They don't do that. They don't have the tools to do that. They look at published financial statements and say, which companies demonstrate cash profits? Actual cash profits. Not on a cash basis.
That's the third financial statement. Besides the balance sheet and the income statement, you've got statement of cash flow. That's the one that you're focusing on. Is it
No,
right?
they're not. They're focusing on the income statement. They're looking at the income statement and
You
saying,
have to reconcile that to the cash flow statement.
well, if you take a look at the top, and I don't want this to be an accounting lecture because it is quite technical, but if you look at free cash flow, oh, yeah, you don't need to fall down, that's for sure. Thank you. No, if you take a look at the definition of free cash flow, hold on, if you take a look at the definition of cash flow, here's what they do. They take their revenue, accrual basis revenue, top schedule tells you. They take out the expenses on an accrual basis, they take out the interest, they take out their taxes, and they take out what they're making for long-term investments, and that's the excess cash flow. That's it. No one says undo accrual basis. Nowhere. Nowhere. But what you are doing, you're dealing with companies, and if you look at the second one, it tells you, and by the way, this is why we love it, because if you generate excess cash flow, you're profitable and you're in control of your own destiny. Why? Because you can do the following. As he said, you can buy back your stock, you pay dividends, you participate in mergers and acquisitions, etc. So I don't think anyone's saying undo the accounting principles.
The follow-up question though is, why is company A generating that much more free cash flow versus company B that is not?
Because it's more profitable. Usually these are profitable. The best way to generate cash flow is to be profitable. And that's really, in a way, what he's saying, is let's choose profitable companies. And companies that have the,
So that's a great question, right? Why is company A generating more cash flow than company B? And the simplest answer to that is that it's just better run, right? It's a more well-oiled machine. Yeah, it's more profitable, right? And so, you know, the cash flow is a signal of all those things. People try to look at management experience and all those
That's the
different
shortcut
things.
method of
Yeah.
identifying a good company.
well, no, it's not just, here's the problem. There's a great classic academic debate between growth versus value. If you want to get to the essence of the problem we're dealing with here, is there are two schools of thought. There's the growth school, which says we're going to pay a lot of money for every dollar of earnings, because we're very confident that although they're earning $1 this year, next year it'll be 3, and the following year it'll be 10, and the following year it'll be 20, and the following year it'll be 40. So we're willing to pay, you know, a huge multiple for that dollar of earnings, because we know that in a few years it's going to be enormous. That's what we call Jonathan and I, what, John? You're still worried about the chair?
Don't worry about that chair.
Don't worry about the chair, John. I think it's
Put
fine.
one focus on one side, one focus on the other side.
I am fine.
You're not fine. Sit between the two.
This is really dangerous.
There we go. There we go.
Hope they don't part, because they're the twain shall meet anyway. You heard about the Red Sea that parted?
There we go.
You may watch it.
That's good. So that's good, that's good.
Anyway, so do you understand there's this great intellectual debate that goes on every day in every wealth manager's office, growth versus value. And there are people who believe that the reason we should buy growth stock is where you pay 50, 70, 100 times every dollar of earnings, is because we're confident that one will become 3, will become 5, become 20, and in another 5 years it will be earning huge amounts relative to the money we put in. And other people say, and Buffett is more in this category, we don't want to pay that huge multiple, and although he doesn't say this, implied in his thinking and our thinking is, perfection is not dependable, not reliable, erratic. Mediocrity is more dependable. When you're paying $12 for every dollar of earnings, you're much more likely to be surprised by the earnings. You're not counting on massive growth. And that's the essence of what he's really saying, is how do we find value? How do we find lots of dollar returns for every dollar of value? Where do we get the greatest ratio of value for every dollar we buy? And we're not counting on growth. Don't forget, nothing he said, and nothing in here talks about expectation of growth. because that's not what's in the calculation. Now, most people look at, well, what's the growth we're going to build in? Are we building in a 10% factor for growth, 20%, a 50% factor? As Jonathan quoted correctly, trees don't grow to the sky. Nothing compounds at 15% for long. Nothing. And so the beauty of this program, and the reason, one of the reasons we like it, is because precisely that, what I told you, is we're buying current cash flow, not expectation. And Tom, that may be the answer to your question. We're not looking to undo the way they calculate profits. We're looking to see where are the profits. And if they have free cash flow. By the way, Enron had no free cash flow. Just want you to know that. So if you want to commit a fraud,
I saw the movie.
the chicanery that you can do when you don't have to pay dividends, you don't have to do buybacks, and you don't have to generate cash, well, then you can keep going. So I hope that answers you, but I wanted to just, and just going back to the early point that Jonathan made, which is at the core of what we do at RVW. I'll come to you in 1 second. At the core of what we do at RVW is we don't pick stocks. We pick a series of definitions, and that's what he said, and that is true. So when we go to sleep at night, and this may sound arrogant, but it's true, everyone in this room is an investor in RVW. Let me tell you why we can sleep at night, and why peace of mind is the thing we promise, and why, by the way, we called our company RVW after our revered hero Rip Van Winkle. Because he taught everybody that you can sleep at night if your portfolio is doing well. And what right do we have to sleep at night? I will tell you. When I first told my wife that, she thought I was exaggerating. I said to her, you know, Glynis, you know who Warren Buffett works for? She said, who? I said, for us. For us. She says, you've got to be joking. I said, I'm dead serious. Warren Buffett works for us, for the people in this room. We are the shareholders through various funds. Tim Cook, who runs Apple, works for us. We are the shareholders. We own the company. And that's what Jonathan said so correctly. We're not buying pieces of paper, frantically hoping they go up the next morning in value. We're buying long-term ownership positions, fractional interests in great, successful companies. And so that's the job. That's what we're all seeking. But the beauty of the system we've employed is we're not here figuring out whether Apple's good, bad, or indifferent, or whether Berkshire Hathaway is a good, bad, or indifferent company. We have a sets of rules. And this is one, free cash flow. We have growing income, growing dividends, and various other financial strength of the balance sheet. All series of attributes which are either present, in which case it's included in the fund, or absent, in which case it's kicked out of the fund in a tax-free mode. That's the source of peace of mind. That we can sit here, a bunch of relatively ignorant people about how the businesses actually work. None of us knows how Apple makes iPhones or iPad. We don't have to. We own the company. We own the companies. That's what shareholders are. If you think about it that way, then the question is, what kind of companies do you want to own? Not what stock you think is going up next week or next month. It's what kind of companies do we want to own? That is what we're obsessed with. And I'm happy to tell you, we own thousands of very successful companies picked in what we call a Darwinian, best of breed, survival of the fittest mode. And as someone who comes from Africa, I can tell you, one of the images I get from safari, anyone been on safari?
There were two people that want them.
Put it high on your bucket list. When you go on safari, here's what you're going to see. Migrations of animals across the plains of Africa. We've seen it, Serengeti and so on. And what you know about those migrations of animals is that the animals at the front of the pack are genetically perfect specimens. And as you look towards the back of the pack, you get to what we used to call in the army, the sick, lame, and lazy. And those animals, unfortunately, are the fodder for the predators behind them. That's just the way the world works. We think businesses are just the same. And if you looked at the economy today, any one of you can tell us which companies you think are at the front of the pack, surging forward and leading the troops, and you know which companies are at the back of the pack about to be eaten by the predator following them for its next meal. And if you want to know what we focus on, it's how do we own an overwhelming majority of the companies in the front of the pack, and how do we have a systematic, orderly way to, in a tax-efficient way, drop them as soon as they begin to decline to the back. That is the RVW story. And why do we like cows? Because it does what we do in a very scientific way. And it focuses on one particular attribute. And we don't just pick one particular attribute. The academics, the science, the research, the Nobel Prize winners tell us that there are attributes, factors, that are present in companies that do better than others over time. Not all the time, but over time. And that's what we do. So we find out we don't have to do the research. We sit on the shoulders of giants. We're pygmies. Humble pygmies who sit on the shoulders of giants. And in that way are the tallest guys in the room. Because we sit on the shoulders of about 24 people who really know what's going on. And they're not on Wall Street. They're the academics. Professor Jeremy Siegel from Wharton. I don't know if you've heard of him. Professor Eugene Fama, who won the Nobel Prize. Markowitz, Sharp. These are all famous people. Warren Buffett, Charlie Munger, and a few others. We sit on their shoulders. We drink their words. We live their philosophy. That's what we do. We don't have anything original. I want you to know, RVW does not generate one original thought or strategy. Our job is to find the high voltage outlets and to plug into them. And cows is one of the high voltage outlets that we found. That's the RVW story. Let me just go back though, if I can, to Aidan. First of all, thank you for your presentation. I just wanted to mention a couple of things that you said and kind of key into them, and then I'd like to move on to some other conversations. First of all, you spoke about the broad indexes. I want to just talk about, why don't we just buy the S&P 500? Which is probably a very frequent question you might have thought of, and certainly people have asked us. And that is the best known index, probably next to the Dow Jones. And I want to tell you why we do not include the S&P 500. Because you should know. Number one, it's committee selected. You already know nothing we do involves judgment. Everything we do is rules based. If you ask the S&P 500 members what it would take for a company to be kicked out of the S&P 500, they wouldn't tell you. And if you said, well, what would it take for a next company to be included in the S&P 500, they wouldn't tell you, because they don't have a methodology. They have a feel, instinct, impulse, judgment. We don't have any of that. Do you know that our biggest challenge, the people, Jonathan and I, and the people at RVW, the rest of us, is to suppress instinct. Instinct will lead you astray. It'll always cause you to buy the wrong thing, wrong time. It'll always force you to get in at the top and out at the bottom. Most people do that, by the way. They get in at the top when all their friends are getting in, once again, from safari. You know what animals do when they feel comfortable? They herd. They hang out together. Do you know what they do when they sense danger? They flee. I'm sorry to tell you, we've got the same genetic makeup. We all hang out together when we feel comfortable, and we flee when we sense danger. That's why most people buy when everyone else is buying at the top. They bail out the bottom when everyone is panicking. That's why they're still trying to figure out why Warren Buffett's rich and they're poor. Let me tell you, that's the reason. Because they honor their instincts, and your instincts will lead you astray. We get calls, thank God, very few when the market's collapsing. Should I get out? I said, of course not. It's time to buy. You know, time to buy. You know, Buffett says, get greedy when others are fearful, and fearful when others are greedy. So, but that's the problem. That's what we learned from the wild. So we're not there to buy at the top, buy at the bottom. We buy all the way along. Every day is a great buying opportunity for people who hold long term. So the S&P, just back to the S&P 500. So here's the problem with it. It's committee selected. We don't use committees. Anybody sat in a committee? Homeowners Association, school board committee, synagogue or church committee? If you have, you'll know why we think what we do about committees. We have no respect for committees. We don't want to sit in them, and we don't want to listen to them. The S&P 500 is committee selected. Number two, it is, hello?
Sorry.
Number two, the weighting is not equal. It's weighted relative to the market capitalization. That means that the most expensive companies get the largest allocation of your money, and the least expensive companies get the least allocation to your money. Which means, if you want to put it crudely, you're overweighted into the most expensive and overpriced and in favor, and underweighted to the least expensive and underpriced and out of favor. You already know what we think of that strategy. You don't want to put most of your money into the most expensive and least money into your least expensive. You wouldn't decide anything else in your life based on price. Imagine going into a store with your friend or your wife and saying, I'm going to buy you a watch, and I'd like to buy the most expensive watch on Rodeo Drive, which is the, you just wouldn't do that. The way you buy a watch, I assume, or the way you buy a car, is to start off with, what attributes are you seeking in the watch you're going to buy?
But it works.
No, hold on, let's think about it seriously. If you were going to buy a watch, you'd probably know before you go in. Do you want automatic? Do you want battery operated? Or do you want a manual old-fashioned watch? Do you want gold, silver, plated, real? Do you want a date? Do you want a leather strap? Do you want a metal strap? Once you decide, now you go and buy a watch. And what you're looking for when you buy is the best value with the attributes that you seek. If you want to understand attribute selection for stocks, that's what we do. We pick the attributes and we go shopping. That's the RVW way. It's a way that makes compelling sense. It's the way you live your lives, the way we live our lives. It's just that in the stock market, something weird happens to people because you have two powerful passions at work called fear and greed. And every day we see the clash in the market between fear and greed, between hope and desperation, but seriously, between optimism and pessimism, between bulls and bears. That's the stock market. And the whole secret, the whole story is to ignore the day-to-day movements and to look at the fundamentals. And if you want to know what Cows does, that's what they do. In a ruthless, factual way, they seek out the fundamentals of a particular attribute which has been shown to deliver outperformance over time. And that is companies that generate free cash flow. I could give you a whole lecture on other methods of seeking. I'm not going to do it because this is the time for Cows. Just a couple of other things I wanted to mention before we go. One of the things that Aidan mentioned is this idea of interest rates affecting prices. I want to give you a way to think about it that may help you. I want you to imagine that there is a seesaw at work in the world between interest rates and asset values. And the seesaw works like this. When interest rates go up, asset values come down. And when interest rates go down, asset values go up. If you want an explanation, I'll give you one, but just assume for right now that that is the way the world works. Once you've got that, you already know where you're going. You already know that when interest rates go up, values of everything comes down, bonds, real estate, and equities, for the reasons that he told you. But don't even worry about the why. Just worry about the what for right now. Interest rates go up, asset values go down. That's the first rule I want you to understand. It's a rule. We don't make it up. It's like gravity. That's a rule of the financial world. Second rule I want to tell you is that there's a way that interest rates work. In theory, interest rates comprise two things. A reward for deferring consumption. In other words, the market rewards you for spending your dollar in a year's time rather than now, plus compensation for anticipated inflation. That's how interest rates are determined. So when people expect inflation to be high, interest rates go up because they have to be compensated. But if you want to think about the mathematics, that's it. That's the second rule, how interest rates are determined in the market. And the third rule, and with this I'll leave the rules alone, you don't have to decide what interest rates are going to be. You can go and determine them based on what the market expects. You know, we don't anticipate, predict, or project. Uniquely, no one at RVW looks at the future. We look at the present. That's our job. So you're not going to, if you call up Jonathan or I or anybody and say, what do you guys think of Apple, you know, any company, really? Or what do you think is going to happen with the market? We don't have any ideas. But we will tell you what the market thinks interest rates are going to be. Because there are futures for interest rates. See, that's the beauty. We don't have to tell you what interest rates are going to be. There are future markets that tell you what the market thinks interest rates will be. And I'll tell you what the market thinks right now, just so you know. The market thinks there'll be no further Fed fund increases, and decreases will begin either at the beginning of this year or they'll begin to decrease next year. It's not our opinion. That's the market. That means, if they're right, that equities are in for a stable period, maybe some volatility, and then solid declines from the end of the year onwards into 2024. That's the market, not us. Also, what the market's telling us is that there's not going to be a very deep depression. There's not even going to be a very deep recession. There's going to be a moderate, rolling recession, which will come out of probably by the end of this year or early next year. Not because of what we think, the market's telling us that. Hence, our case for optimism in the next year to 18 months. I just wanted everybody to understand that. There is one thing I wanted to point out before we get. In fact, I'll deal with it later. I think I want to spend a little time with Aidan. Aidan, there are some issues that are coming up that I think are weighing on our minds. We're going to hit the debt ceiling pretty soon. People are very concerned about that. Does everybody know that the United States is basically a large printing press, printing huge numbers of dollars, and that every now and again, because of political games in Washington, they put a limit on the amount of dollars that can be printed, and then they have a hoo-ha for a couple of weeks, and then they start printing again. Everybody understand that's the way Washington works. We are going to be hitting one of those debt ceilings in another month or less. How do you feel about the debt ceiling? How do you think it might be resolved, and how do you react to that?
Well,
Oh, thanks, John. Thank you. One thing
So,
to give a man 2 chairs, it's
the-
another thing to give him some water when he's thirsty.
I need wine. The simple answer to that question is, I do not think that we'll hit the debt ceiling. And I do not think at all that we will default on our debt. So that's been something that people have talked about. But the ripple effect of as nice as it would be to just get rid of that debt, in theory, the ripple effect of Uncle Sam defaulting on that debt would be huge. Number one, I'm assuming most of you guys probably own treasuries in your portfolios, so that would mean that you wouldn't get paid on those. That's the number of people out there in the United States and globally that own treasuries. It would just be a huge ripple effect for financial markets. And then number two, things like Social Security and Medicare and all those types of programs, they would not be able to get payments from that. So the ripple effects would be far too catastrophic, and I don't think that our government, divided as it might be, is willing to, take us down the path of catastrophe. The current solution that the Republicans are fighting for, and this isn't a political thing, this is just kind of what's going on, is that they're willing to raise the debt ceiling by, I want to say it's 1.6 trillion dollars in exchange for $4.8 trillion in cuts over the next couple of years, and that's the kind of brinksmanship that's going on right now in DC. Whether or not that happens, I don't know necessarily, but I will say that this brings up a good point, and it ties into what we've been talking about with companies, is that the federal government has to borrow at whatever the interest rates are that the market determines, right? And so when interest rates go up, that means that taxpayer dollars, a higher percentage of those, are just going out the door so that the federal government can, fund their interest payments over time. And so this is part of the reason that this is important right now. It's the same way with companies. When interest rates go up, a higher number of profits and cash flows are going to go out the back door. So at some point, hopefully, we'll get our spending under control to some extent. But I don't think that the federal government is going to send us down the path of, economic depression in order to, prove a point over the next couple of months. There's been a couple situations like this in the past. 2011 was probably the biggest or most recent that people could remember, but there was a fight over raising the debt ceiling back then. All I know is that I hope that they get it resolved soon, because the longer they take, the more skittish people out in the economy spending money and investors get over time. So it's a bad thing for everyone to delay it for far too long.
Thank you. How much impact do you think it has on our strategy at RVW? Zero. We don't care about what happens in the next month or two. We know we'll get through it one way or another, and the companies we invest in will continue to do very well. Thank you for that perspective, though. I just want to make sure you understand this is an academic question. It doesn't impact us one bit. I want to ask you one more question, and then I'm going to get into more specifics with the other programs we wanted to talk about. How do you feel? There is a lot of talk that the dollar might become less critical to the world economy. People are now doing transactions in renminbi, which is the Chinese currency, and Iran. They should slowly disintegrate and rot in hell. Iran is selling oil in currencies to China without using the dollar. Any thoughts on the de-dollarization of the world as a reserve currency, which there's a lot of talk about, by the way?
Yeah. Do I have your permission to nerd out on this one a little bit?
You can nerd out on
okay?
this one, no problem. Just do it briefly, because we want to move on to two.
Yeah, so I think this is a great question, and if you look through the economic history of the world, there have been other reserve currencies, which is what's basically the most kind of powerful currency in the world. There are a number of different factors that weigh on this, but there's a few that I think are really important. it's not out of the question that the dollar will potentially weaken slightly moving forward relative to certain economies, albeit a lot of those are probably emerging markets types economies. And that's because we run a trade and a budget deficit every year. And so over time, that's going to weaken the value of your currency. Don't want to get kind of into the technicals of that, but think of kind of the same seesaw thing there. That being said, I don't think that the U.S. at any point in the near future, I've seen a lot of the academic work, is going to lose its status as the world's reserve currency. And the reason for that is that of developed markets in the world, I mean, we have basically the best economy bar none versus all of the developed markets in the world. If you look at Europe, they have just as many, if not more, issues with the amount of debt that those governments have, and they have higher social spending, which is going to be difficult to kind of peel back. Other developed markets, Japan is a great example. They have an aging population and they don't have enough people to replace it, which means their tax base is going away. They have those same issues. And so then you think of, I've seen a lot of stuff like, is China going to take over as the world's reserve currency, right? Now you all, as an investor, or as a company or whatever it might be, as a central bank, right? Would you give all of your money to a government where one person who has total control over it at the snap of a fingers could just say, we're not going to pay you back? Probably not, right? So the kind of some of the up and coming powers of the world, they don't have the rule of law or the systems in place that we have in the United States to actually take over as a world reserve currency at any point in the near term. And if you look at developed economies, sure, the U.S. has its problems, but it's not anything more difficult than what's going on in the rest of the world, and our economy still continues to grow faster than basically all of the rest of the developed world. So,
Fantastic. Thank you so much. Thank you. Been terrific. Thank you very much. Thank you. Okay, we're now going to deal with two other programs. Jonathan, you're going to deal with JP Morgan Reed?
Yeah.
If you open up the handouts, you'll see two slides there. And the reason we've introduced this product, and as I've told you before, we don't introduce anything without all the senior people at RVW investing first. Not only do we want to make sure that the investment programs make sense in terms of track record and analytical stuff, but we also want to make sure that they actually work. And so I'm happy to tell you that the senior people at RVW have invested in JP Morgan REIT, and it's done really exceptionally well, producing cash flow that's tax sheltered and growth, and we're very happy with it. And Jonathan, if you want to come up and just run through that, that'd be great.
So invented in the world over the last few years has been this concept of a non-traded REIT, real estate investment trust. One of the problems with equities is the fact that it's priced every single day, all day, every day. And you can look at your watch or your phone or any one of 100 devices and get pricing, and it creates all kinds of emotional factors that weigh on the price. And what it came about a few years ago was this non-traded REIT concept. And it's the same way as you don't lose sleep if Zillow says your home is down 10 or 20 or 30%, it's still your home. And you can invest in it with greater confidence longer term if it's priced and traded in a way that we all think of real estate. So along came things like B-REIT, which is Blackstone's REIT, which is the behemoth in the room, and then things like Invesco's InREIT, which is a fantastic model. But JP Morgan's REIT is sort of newer to the block. It includes things like development. It has a 10% sleeve allocation to international, and it's got JP Morgan's bench behind it. And so we include it. It's got, basically the problem with development is the risks of running out of money or running out of time, and you've got JP Morgan's capital behind you, and actually pre-sell these deals even before they break ground. It's very, very compelling. So it's new, and it's being bought with every dollar invested with, at present, no leverage. So it's a very attractive tool. It's brand new. There's only 6 assets in the property. in the portfolio, but it's run by guys with decades and decades of experience. And for people who are looking to access real estate, which in economic terms is 5% cash flow free of tax, with quarterly liquidity, it's very, very attractive. So if that's applicable to you, fantastic. I'll keep going with Cliffwater.
Oh, great, John. Good.
Another strategy we're including in our portfolios now is private lending. Businesses are having a hard time borrowing from banks. They're having a hard time floating public debt. And so they're looking to private credit to run their businesses. And they're paying a premium. And now is the opportune time to do private credit. There's two things going on in the markets right now where private credit is very, very attractive. And there's a strategy in there called Cliffwater. This was printed actually while I've been away, so forgive me. I think it's 10.6% yield on that.
It is. Yeah, you can look at it, John. Here, you can actually take it. It's there. It's the last. I think it's the
I'll
last
take
two
it because I've been traveling this week.
Yeah.
This is new data.
That's it.
10.6.
Oh, so it's 10.6 now.
Yeah, 10.6. So you
Yeah.
can see page
Oh,
7.
it's on the next page.
Oh, yeah, yeah, yeah.
So there's two things going on in the world right now that's happening. SOFR, which is the new LIBOR, is extremely high. And then the spread between SOFR, the new LIBOR, and the price that people are willing to pay for capital is also very wide. So you've got a high base and a huge spread. And that's unique. That's very
And
unique.
banks not willing to lend.
And banks not willing to lend. So if you're a business that's in pharmaceutical technology, healthcare, whatever, and you need access to capital, you're going to go to organizations like Cliffwater, there are a few others, Apollo, Blackstone, and borrow money. You're going to pay about 11.5%. That's a lot of money. That's a lot of money. But that's the cost of capital right now, because the base rate, LIBOR, now called SOFR, very high, and the spread between the base rate and the market is also very, very large. And so we, as an investor base, can command north of 10% interest on money that we are willing to lend to those businesses today. And if you do it through a strategy like Cliffwater, you've got broad diversification of borrowers. The particular strategy has 3,100 borrowers who are borrowing money, very low leverage. Again, it's like less than half, and they're almost all first position liens. So in the capital structure, we'll get paid back first if these businesses were to have trouble. And so between J.P. Morgan, REIT, and others as well as Cliffwater, there are others as well. We just simply wanted to make you aware, or investors aware of these alternatives to equities. Equities are definitely the best way to grow wealth over time, but with a hell of a lot of volatility. A lot of clients just don't have the stomach for volatility, and they need current cash flow, and that's where we look to.
Just to kind of wrap up, first of all, thanks everybody for coming. Really appreciate you coming out here. And it's an honor to be in business with you and your family members. And of course, the greatest way to express gratitude is to send your close friends and family. That's how we grow. We're over $1 billion, I think well over $1 billion now. And that's because people send us their friends and family members to entrust their wealth to us because of our conservative, tax-efficient way. Just a couple of minor things on Cliffwater that I think are, first you got the chart, but Jonathan said this, but I want to just re-emphasize. 42% average loan to value. That means after they value the assets, they lend less than half the value. If everything these companies own dropped in half, we would still be more than covered for the loans that are made. They're almost all floating rates, and that's why the rate went up. You saw the first one was 10.1, and then went up to 10.6. That's because as the interest rate levels have gone up, so these, because they're floating, have floated up. So they've gone up to 10.6. They will probably come down, by the way, as interest rates come down, but nowhere near. They're still going to maintain a very healthy margin over all other interest rates. Very broad diversification means no one company or even group of companies can make a difference when you've got 3,100 borrowers. And the average earnings, so we're not lending to corner 7-Elevens or, whatever, small little stores. The average earnings are $98 million annual EBITDA. So you're dealing with, middle-sized, medium-sized companies, and we're almost always in first position on the balance sheet. That means these claims are ahead of trade creditors and other lower-rated lenders. But this is ideal for pension plans where you don't pay tax, and if you can earn 10% plus in a sheltered environment, you're doing pretty well. The money doubles every 7 years, and that's a pretty good thing. The real estate is great, as I said, with inflation, cash flow, and tax benefits. It's a great addition. And cows is a terrific way to access quality companies at a bargain price, because you're paying very low prices for every dollar of free cash flow. That's really what it's about. The cows method is, how do you find underpriced value stocks? And you're looking for companies that generate high cash flow relative to their price, and are therefore bargains compared to the overpriced companies that have the followers, the troops, believing that their growth will continue at extraordinary rates. And so these are 3 programs that we've introduced. They're all available, they're all excellent, and we're invested personally in all 3 of them. And invite you, if you have an interest, contact us. We're not active salespeople, we don't pitch and call every day. You know what we do, and if you have an interest, we would love to hear from you. One other thing, we're all of us are CPAs and trained personal financial counselors. We spend a lot of time on things other than wealth management in the personal financial planning arena. I will tell you that I'm traveling to London on Saturday night to meet with 2 very large clients there, and nothing on the agenda will be dealing with investments. Not one thing. They're delighted with the investments, everything's doing really well. We're dealing with estate planning issues, transition issues of businesses, family wealth issues, political stuff in the family for the next generation. We're dealing with every imaginable aspect of financial planning other than portfolio design, with which they're very comfortable. Just wanted to mention that. So don't hesitate, we're free. We don't have a clock. You can call us, we're there for you. We have a group of really smart people, not me. But I'm surrounded by people who are much smarter than I am. I'm happy to be the dumb guy in the room. We have really smart, very well educated people. We have a tax attorney of counsel. We have an estate planner of counsel. Free, no charge, no invoice, no clock. Call, we're happy to help you with anything. That's what makes us very different. We care about you. We don't just manage your money. Big difference. Thank you everybody for coming.